Okay, class, let's learn about includable income, that's taxable, and excludable income, non-taxable, by taking a look at problem 56 here at the end of chapter 4. And what we'll do is go through this problem, and when an amount is taxable, we'll put it under this includable column, and if it's non-taxable, we'll put it here under excludable. So we have Pat. Pat was divorced back in 2012, and in the current year, that's 2017, she receives alimony of 18,000 and child support of 4,000. This child support is for her 11-year-old son who lives with her. So what do you think about this 18,000 alimony? Is it includable, taxable, or excluded? Well, we know in the previous chapter, alimony is taxable as long as it meets certain conditions, and then the child support is non-taxable. Also, any property settlement that she would have received is non-taxable. Okay, so the child is living with her. Her former husband asked for her to sign an agreement giving him the dependency exemption for the child, but she declined to do so. So in other words, the dependency exemption is going to be claimed by Pat. And if she wanted to give up that exemption to the other parent, what she would need to do, let's see if we can get the form here. What would be life without Google? Yeah, IRS Form 8332. So let's look at this form. So this is what the custodial parent would have to sign and give to the non-custodial parent if the custodial parent wants to give up the exemption to the non-custodial parent. You can either do it by 1 year at a time or until the release is taken back. Yeah. And in this case, this form wasn't filed or given to the ex, so our taxpayer, Pat, will be um, claiming the exemption, and we'll calculate that further down in this column here. Also, during the current year, she receives 3,200 of salary, and we know that's taxable, so we'll put it here under the includable column. The school district paid her medical insurance, this premium cost of 6,900. What do you think? Taxable, includable, or excluded? Well, we learned here in this chapter, insurance paid by our um, employer, almost every type of insurance premium is non-taxable. Yeah. So the additional benefit paid by the employer is group term life insurance. The coverage is 40,000, and there's an exception for it to be taxable if the coverage is over 50. Now, what's taxable is not the coverage, yeah? What's taxable would be the premium if it were taxable. In our case, we're given the premium to be $160 per year. And because the coverage is less than 50, this is an excluded benefit. Let's call this, let me spell it out here, group term life insurance premium. Not the insurance itself, yeah, the benefit, but the premium cost is a tax-free benefit to our employee, Pat. Next item is during her marriage, Pat's parents loaned her 8,000 to help with the down payment of her home. Her parents told her this year being 2017, that they understand her financial problems and that they were canceling the balance of the loan, which was $5,000 left over of the 8,000 that was lent. Um, they did so because they wanted to help their only daughter. Okay, so we learned here in chapter 4, this is called cancellation of debt income. And generally it would be included, but because it's more of a nature of a gift here given by her parents, this cancellation of debt gift is non-taxable. Now, if the cancellation of debt was more of a business setting, a loan from a business, a financial institution, and it was canceled, then it would be under the includable column. Let's see. Is that all the income we have? Okay, next is Pat received dividends from National Motor Company of $4,600. Dividend income, we learned in the previous chapter, is taxable. And if this were qualified dividends, it would be taxed at lower rates than the regular rates of the taxpayer. We're also having 4,600, interest of state of California bonds, 2,850. So here's the so-called municipal bonds. And again, we learned back in chapter 3, this is an excluded income. Muni bond interest income. Okay. You know, to get this type of dividend income and to get this type of interest income, the underlying stock of this National Motor Company, the underlying value of the bond, you're talking probably hundreds of thousands of dollars worth of investment. And here they're saying inconsistently she has some financial problems. She could actually sell these bonds or redeem the stock, yeah, and she could get more money. But again, no matter her financial condition, if this loan is being forgiven by her parents, it should be excluded. So if we take a total of our income, let's see, this is our gross income, yeah? Or because we don't have any adjustment, this is also our adjusted gross income for tax purposes. And the total of the excluded income, here this is tax-free, $18,910. So now in our tax formula from the AGI, we would subtract out either the standard deduction or itemized deductions. And we're told that her itemized is 9,600. It's not, may not be fully available in terms of 2017, the amount of standard deduction. But if you take a look at the link in our Laulima folder for this miscellaneous files. Let me go into the folder here. So this link right here, the inside front cover of our textbook may not be readily available online in the ebook version. So I've posted it here, linked it here. And if you download it, this is what you would see. The tax rate schedule. And then if you go further down, the amounts of the standard deduction. It may change usually every year for inflation. So this is 2017. We're assuming that Pat's filing status is this head of household. And the standard deduction of a head of household is this 9,350, which is less than the given standard deduction of 9,600. So we're going to use the larger of the two. Let me put it in as a negative here. Another deduction we learned back in chapter 2 was the exemptions. be they personal exemptions or dependent exemptions. So we have one for Pat and one for her son. That's a total of two. And the amount of the exemptions here for 2017 is $4,050 each. So we double this. 8,100 is the amount we're going to deduct for Pat's two personal exemptions. So subtracting the itemized deduction and two exemptions from the AGI, we get here is our taxable income. And generally you would look this up in the tax table, not necessarily using this tax rate schedule, this rate schedule here. The tax table is not available yet for 2017 as of this recording. Yeah, so we generally would use these rates scheduled for the head of household. We were told to only calculate taxable income, but let's go ahead and try to calculate the actual tax. So our taxable income of 36,900 falls within this range right here. Over 13,350, but not over 50,800. Again, you have to make sure you're looking at the correct filing status. We're assuming again Pat is head of household. And before we actually use the amounts here, keep in mind that the dividends here, if they're so-called qualified dividends, we're going to pull it out. Let's subtract it here from the, let's try that again, minus this number here. Minus this cell. Okay, it's not doing it. Let's try this. Equal minus the dividend amount. And then the difference, I rather use Excel. I'm using Google Sheets right now, so it's a little bit different than Excel. I'm assuming this is qualified dividends I'm subtracting to get the taxable income without qualified dividends. This qualified dividends will be taxed at lower rates. So in the case of our taxpayer, let's go back to the schedule here. If we fall within this range or this range, that's at the 10 or 15%, our taxable income, this number now, this 36,900, then our qualified dividends will be taxed at zero. If the taxable income falls within the 25 and 35% bracket, the qualified dividends will be taxed at 15%. And if our taxable income were greater than this amount here, we would take out the qualified dividends and tax it at 20%. The rest of the income will be taxed at the regular rates here based upon the schedule. So this 32,300, we took out the qualified dividends, falls again within this same range. Now, if the qualified dividends would move you between the 0 to 15 to 20%, you would really have to use the worksheet in the instruction booklet for the 1040 form, yeah, to get the amount of the tax on the qualified dividends. But in my case, all of this qualified dividends tax at zero, and the rest of the taxable income, I would use the tax table, which is not available right now. So my only result is to use this tax rate schedule. So the bracket cutoff is this 13,350. And the excess over that amount will be taxed at, as you can see here, 15%. Yeah, this 18,850 excess over this bracket limit, taxed at 15%. So if I multiply out the two, the tax on this excess comes out to 2843. Now I still got to figure out the tax on this amount here, which you can see is taxed at 10%. 10% of this is this amount right here. So all I have to do is just add this 1335. So the total tax for Pat is 4178. And again, we took out the qualified dividends and taxed them at the low 0% rate. Most taxpayers that have dividends probably would fall in the 15% rate, and the rest of the taxable income would be taxed at their regular rates. Okay, and look at this. This 18,950 of excludable income, tax-free, no tax on this. Now, if you were to fill in the tax form, I've already done it. Here you would fill in, of course, Pat's contact information, which we don't have a lot of. Here's the filing status, I'm assuming, head of household, because the qualifying person that makes her head of household is her son, which we don't have too much information. So Pat has one personal exemption and one dependent, a so-called qualifying child exemption that we learned about back in chapter 2, for a total of 2 exemptions. That's the I believe it was $4,050 each deduction on the next page. So the 3 income she gets taxed on, the includable, is her salary, the dividend income, which I'm also assuming is qualified dividends, also reported here on line 9B. In other words, this qualified dividends are inside of this ordinary dividend figure. The tax-free interest is still disclosed here, but not added into this right-hand column to get the eventual taxable income. If the interest income or if the dividend income is $1,500 or more, you gotta fill out a Schedule B and attach it to this 1040 form. If it's less than $1,500, then you still have to tax it here in this column, but you don't have to fill out the Schedule B. And of course, here's her alimony. No child support, no taxable property settlement. So the total income minus 0 adjustments gives us an AGI here at the bottom of the first page of the 1040, 54,600, which we recopy to the top of the next page. And then we subtract out, in our case, the itemized deduction versus the smaller standard deduction. Again, notice this is the 2016 form. The 2017 form is not available, so don't use these amounts here in the margin for standard deduction if you're asked to do the 2017. Here's the 2 exemptions being subtracted out to get the taxable income. And then generally we would look up this number on the tax table. But because we have qualified dividends, we backed out from this number the 4,600 of dividends and tax it at a lower rate. In our case, it was 0. And then the rest of the taxable income is taxed here, this amount. And I took a subtotal. I can't finish the rest of the form because maybe she would qualify for something called child tax credit for her son. We weren't given any income tax withholding amounts probably taken out of her paycheck. So we won't know whether she had overpaid or underpaid during the year to get a refund or a balance due. I'll post up this spreadsheet and the 1040 form in our Lau Lima Chapter 4 resources folder. Yeah? And eventually I'm going to have you do an actual form like this, a more comprehensive one as your project. That'll be due after we pretty soon after we finish our chapter 4. Okay, talk to you later.